They don't call them astronauts. Why is that important? If you're not an astronaut, there's no obligation to rescue you if something goes wrong. It's a lot of money to set up a rescue launch. If it can even be done, it's something really important to think about, and that difference as we cross this threshold from having astronauts in space to having real people like me in space.
And when we are able to make it to space reliably enough, there's still a host of other legal and ethical issues to consider before space tourism can truly take off.
There are so many gaps in space law that we are going to have to put in a lot of sort of basement ideas. And so, for example, the Outer Space Treaty is a treaty that offers principles and guidelines for state activities, for the activities of national governments. It doesn't talk about private entities, it doesn't talk about humans in space. So now if something goes wrong, so let's think about all the times hotels on Earth are sued, right? So slip and falls, you step on something in the bathroom, you sue the hotel, and it becomes a private lawsuit. Because of the vagaries of international law, if something happens in space, well, boy, you can sue the state that launched your spacecraft, you can sue the company that brought you there, you can sue the hotel, you can sue the individual, you can sue every government related to that, because the way the Outer Space Treaty and the Outer Space Regime have set this up is that anything that happens in space first has to go through a diplomatic channel before you think about suing in a court of law. And so every single slip and fall in a space hotel is a diplomatic nightmare. And so we really need to figure that out before we start sending a lot of people there. You think about human rights in space. Here, we don't think about a human right to oxygen because it's kind of all around us and free. It's not in a space hotel. So what happens if something happens and the oxygen depletes? Who gets the oxygen first? And then, of course, let's not even think about the labor. How do you treat your labor in a space hotel where that person may be there for 2 or 3 years without coming back to Earth? So a lot of things to think about.
Space habitats are more likely in the near future to focus on research missions and be a home for experiments that can't happen as easily back on Earth.
Space hotels, I think they garner a lot of headlines and a lot of news, but at the same time, that's not the first thing that you're going to see happen. They don't offer the compelling business case, I think, that you'll see from a place that wants to manufacture pharmaceuticals or a new type of crystal or some type of filament or fiber optic cables and other things that you can do in microgravity. The things that are actually, a high value finished good, when you get that back to Earth and you sell it for a very, very huge profit margin. That's what's likely to happen in space, as opposed to having a real estate platform that you sell to a tourist. A space hotel is really interesting, and it will probably happen, but it's not likely to be at the forefront of space commerce.
Even if space hotels are right around the corner, don't get too excited about booking a trip in one.
It's not a cheap ticket to ride to space, and it's going to be, millionaires and billionaires and that sort. But at the same time, the point was made that in the early days of airline trips, that was also a completely unaffordable ticket for most people. Those people who flew were people of means, and over time it becomes affordable to the masses. And I think that's the goal for all the entrepreneurs in space as well, to get those costs down to a point where it's not $10 million or $5 million or $300,000 ride into suborbital space. When it becomes more like buying a first-class ticket to go to Europe from the United States. So that's the goal, and the question is, can we get to that point?
Given the immense operating costs of getting to space, it may be years, if ever, until space tourism becomes a profitable venture for any of these companies. Virgin Galactic, the only publicly traded company of the three, has had a particularly rocky year, initially riding on the momentum of a SPAC deal, but more recently beset by launch delays and major funders, including Branson himself, selling large quantities of their stock in the company.
Space is really, really, really hard, and it's an absolute cliche, but it's one that happens to be very true. It's just really hard to do. That's also the reason that you've seen the delays that, Virgin had talked about flying years and years ago. And it became such a crazy point that Richard Branson actually stopped talking about it when he was asked, because it was never going to be when he predicted. But it's not insurmountable. And, investors have stepped up because this is something that is doable.
Despite the astronomical dangers and costs of getting to space, it may ultimately follow the course of other once fanciful modes of travel.
Wright brothers having, what was by modern standards a very unimpressive first flight, at Kitty Hawk. I mean, you had like less than 20 years later, you had your first airborne ambulances being used to save lives. Fundamentally, the world is a more interesting place when people can go and dance among the stars and such.
The lure of space is innate. It's in our DNA. It's that exploration bug. We are an exploratory species, and we want to go out there and see what's out there.
That vision that I had in 1969 of seeing normal human beings travel into space, it's finally beginning to happen. When you get a bunch of people up there and they can all see it for themselves, that'll create even yet another revolution in how we treat our planet and the way we think about it.
So while 2001 came and went without quite looking like Stanley Kubrick's ultimate space fantasy, 2021 might finally be the year we're catching up.
If you visit California, you might be inclined to go to Disneyland, or jump in your convertible and take Highway 1 up the coast, or maybe make a pilgrimage to Yosemite. All very fine choices. But if you're the kind of person who revels in our planet's extremes, then it's Route 395 that you're after. This one glorious road will carry you from Death Valley's desert floor to sky-high views of Mount Whitney. You can see the 5,000-year-old bristlecone pines, the oldest living organisms. Or the bizarre tufa towers of Mono Lake. And true to California's boom and bust spirit, you can saunter around the ghost town of Bodie. What a novel experience to find an empty American city where all the businesses are shut down. To do 395 upright, it helps to have a guide, and mine is a man named Jan. And his crew,
It's a mess back here.
Aaron
Let's tidy up first.
and Lemmy, the hardest partying dog of all time. Jan agreed to show me some of what 395 has to offer, but only if we agreed not to disclose any locations.
My name is Jan Swirstra. I'm an industrial designer out of LA, and I spend a lot of time camping and a lot of time in the Eastern Sierra. It's a place I love, and sometimes I'm known as 395 North because my Instagram account, and I don't like to be known as that, but I'm trying to use it to set a good example and do more with it than just social media.
Where did we end up camping? We got here late last night. I wasn't even sure where we are.
This is BLM land, right on the outskirts of National Forest, and it's one of my favorite places in the world. Basically, everything outdoors wrapped into one.
Yeah. Good thing about California, man.
Oh, man. We have so much national forest and public land that you can literally just cruise out and find a place to camp. It's ours.
What I wish was mine is Jan's sweet truck.
It's a 2019 Ford Ranger. Has about 200 watts of solar in it and a fridge, and has everything that an RV has except for a toilet, but just on a smaller, simple scale.
And you drive us around day to day in LA.
Yep.
And then just roll out when you want.
It's my daily driver. Handles great. And then when I'm done with work, I can just bail and go camping. So the camper basically has only what I need. Think of it as backpacking with a car.
Yeah.
The fridge has a couple compartments. This is just a kitchen box, stove, utensils, and a bunch of stuff. This one has just dry food. Then when you get inside, there's a bed. The bed flips up, so you've got tons of room in here. This awning is phenomenal. If you want to pull that over.
That's cool.
Let me just pop that up.
Sorted.
So, home on wheels.
Yeah.
This is my vacation house.
Dude, it's so nice, man. Even with his nomad lifestyle, Jan faces the same big question as the rest of us. Do the internet and smartphones have to ruin everything? When you find the super special, beautiful spots, is that you busting out a map and like looking where it might be cool to go, or is it word of mouth and just getting to know people, the locals? And
if I see a dirt road, I just want to go down it. So a lot of it's just aimless rambling. It's a desire to just see something. Check that out. For some reason, it's more fulfilling than getting a recommendation from somebody. Or there's tons of apps and websites now, road trip apps, camping apps. They've proliferated. The knowledge is accessible on the internet, right? I used to fight the geotags, and I would get really pissed off. Like, why are you posting this place? It's gonna blow up, it's gonna get trashed. Now I've realized that you can't fight it. The internet has just shrunk the world. So we're not gonna stop it. We're not gonna stop people from going there. So I'm a lot more focused in conversation now with trying to set a good example. When you go, pick up your trash. When you're pooping out in the wilderness, don't leave your toilet paper on the top. Make sure you follow, good steps for leaving no trace.
as a thank you for this quick guide to pooping etiquette, we made Jan, Heron, and Lemmy some tacos. And we all took in the night sky and knocked back a couple of drinks. Take that, Apocalypse. The thing about good times and serenity in 2020 is that they're fleeting at best. After we split up from Jan and continued on our way, smoke started to envelop us. The plus side was that our RV no longer smelled like feet. The downside was breathing. My man David here suggested that we try and outflank the smoke by cutting through Yosemite. Without a reservation, we had to talk our way in.
Yes, no stopping, no getting out, and
don't go in the valley.
yeah, no problem. We just wanted to get through.
It was a beautiful choice. Glad we got out of the smoke. Whoa, okay. But not quite as effective as we had hoped. Fast forward 4 hours or so, and we had managed to trade the smoky majesty of Yosemite for the smoky, look at it, strip malls of the Central Valley. We have made it, sort of out of the smoke, all the way across Yosemite National Park and here to the gorgeous Central Valley of California. We're off to see a kind of surprising tech startup that is making some pretty strange machines to serve all the growers out in this region. And we're here in this near Fresno. This is California farm country, right?
We're just south of Fresno, a town called Kingsburg. So we're right in the Central Valley of California. Very, very large farming valley here. It's kind of considered the breadbasket of the world.
The Central Valley stretches out over about 20,000 square miles, and the farmers here produce about 1/4 of the food that Americans eat, including a whole lot of fruits and nuts. Tell me a little bit of the background of Gus. I know some of this is like a family business. The roots of this go back a ways. Tell me kind of like how we got to what's essentially like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had had this idea for quite some time about doing a driverless sprayer, and it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots. On this like labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think like 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here, and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command. So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got like a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines. And have you just sold them in the Central Valley, or like throughout the U.S., or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida, in the citrus industry over there, as well as Australia.
And I think you started selling them in like December of 2019.
Yeah,
right?
So we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay, so. And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheap.
Yeah,
either.
I mean, we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just thrive. But basically what we're doing, besides this machine, this is our first machine. We call it Orchard Gus, mainly designed for your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer. So
okay.
Vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV and to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
LQ, who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello?
Hey Danielle, it's Aki.
Come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is LEQ.
Can I take her out for a spin?
Please.
LEQ. Tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her.
Like,
or that they miss
literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
LEQ isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LEQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month. How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LEQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. a large room-sized computer. But now, this artificial intelligence stuff is amazing. LQ?
Yes,
Schedule a doctor's appointment.
no problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the US.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more, because she understood the fact that you need to run after your dreams and work really hard, no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas.
Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousey things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you? I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly, the print was, I could see that quite clearly.
What about this?
I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence, robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. Not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right? As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money. How did the YouTube channel come to be? When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people. What do you need to think about if you're building your YouTube channel? 1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. One, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posted, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You got to make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got a comfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Milken Institute Global Conference in Beverly Hills. Day 2 for us here at Bloomberg Business Week. Yes, it is Tuesday, May 2nd. There's a lot going on. Back at Bloomberg headquarters in New York City, we've got Jess Manton in our Bloomberg Interactive Broker studio. We're also streaming on YouTube and, of course, on our streaming service, Bloomberg Originals. But, Jess, we're less than 24 hours away from that Fed decision, but what we're thinking about, again, is once the regional banks, they are just selling off in a big way.
They are selling off in a huge way, and especially when you mentioned, Carol, the regional banks, looking at the KRE for the regional banking ETF, that's down close to 7% on pace for its worst day since March 13th. That obviously was the heightened time when it came to that banking stress. So, and if you're looking at volume right now, it's actually up 20% over the past 20 days, Carol.
Yeah, so very active. All right, that is certainly top of mind, and it's going to be really kind of at the top of the list of a lot of questions that I'm going to be putting to our guests here at Milken. So coming up, Chris Ailman, Chief Investment Officer at CalSTRS. They've got hundreds of billions of dollars in assets under management. I'm curious to see how he is playing this uncertainty. Ida Liu, Global Head of Citi Private Bank. We'll talk to her as well about the investment environment. Victor Kosla, he's Chief Investment Officer at Strategic Value Partners. He's a distressed investor. So for him, distress, this moment of uncertainty, actually equals opportunity. So it'll be fun to check in with him. Private credit. It is all about private credit here at Milken. So we're going to talk with Oaktree Capital Management's Head of Performing Credit. We also have the Managing Director at HPS Investment Partners. They are a large global private credit lender. So what is happening with the uncertainty in the traditional banking system? How many people are accessing private credit? We know a lot, so we'll get some perspective from them. And then we're going to check in on residential housing. This guest was on my panel here yesterday at Milken. Sean Dobson, Chairman, CEO, and Chief Investment Officer at Amherst, did really well coming out of the great financial crisis, essentially created a business. So is there something in this uncertain environment that's a similar play to what he did during GFC? And then we've got the former CEO of United Airlines, Oscar Muniz. He's got a new book out. He came in at a time when United got together with Continental. It wasn't a great situation. He had some personal health dealings with as well, but he somehow pulled it all together. So we've got a great line just coming up. But we got to get to those regional bank stocks because just as you mentioned, they are under a lot of pressure. PacWest, Western Alliance, really tumbling in today's session. So let's get to it with Bloomberg News. Regional banks and insurance reporter Max Reyes, he's back there in New York. Max, put in perspective the type of selling in the regional banks, which have been under pressure since it all began over a month ago.
Sure. So today we're seeing a number of shares down. And what is kind of interesting and unique about the move is the fact that other than the First Republic news, which at this point is basically a day, 2 days old, there's not a lot to motivate it. And obviously the thing is that the situation hasn't changed radically, but I think what people are waking up to is the number of risks and factors that are pressuring these banks and their profitability, right? So things aren't necessarily much worse, but the situation hasn't changed for the better, which seems to be spooking investors.
So what do we know about PacWest or Western Alliance? I mean, I'm curious if at some point there's some, bottom feeders saying, wait a minute, these are not banks that are going to go down, but I don't even know if you can say that with certainty. What is the thinking around the fundamentals? Because we know all of these regional banks don't have the same exposure or the same risks.
Yeah, so PacWest and Western Alliance, I would say part of why they've kind of been in the crosshairs of investors is because they are both sort of Sun Belt banks with a lot of commercial business. And that means, in turn, that they have uninsured deposits, which became really top of mind after you saw the bank runs in March. But to your point, not all banks are created equal. There are definitely differences in their model and that of SVB and Signature in terms of concentration, that sort of thing. So looking at the two names, on the surface, there are similarities. But again, each regional bank is different. Each regional bank is unique. And I think a big part of it is that people kind of look at the initial read of the bank and take it from there.
And to your point, Max, you were talking about how, as far as the catalysts out there, what could be the new catalyst? And you did point to this note from RBC, which they even said that today's market moves in response, they didn't really feel like this was new, any sort of information or emerging concerns there. I mean, what are your sources telling you? Is it the same thing that we've been seeing, or is there something new emerging there?
I think everyone is kind of as uncertain to whether or not there's a new catalyst as RBC seems to be. I would say that the issue banks are dealing with, the issue that created the situation, which is higher interest rates, which deteriorates the value of assets on a bank balance sheet and also puts pressure on their funding in the form of deposits, that hasn't gone anywhere. So if you're a bank investor and you're thinking about the profitability of these banks or the kind of runway, right, the picture has not improved for you. And if anything, given you haven't seen a systemic sort of intervention on the part of the FDIC, you haven't seen them raise insurance levels for deposits, you haven't seen any kind of backstop beyond the Fed liquidity facility, you could be concerned. But beyond that, I mean, it is kind of the situation we've been in. It's just that there's now one fewer bank operating in the country, and it was a big one.
And where are the biggest sort of cracks reemerging now in the regional bank space when you're thinking about, obviously we were just talking about PacWest, Western Alliance, we've been talking about those names for a little over a month now. Are those still the same key names, or are there other ones coming out that are standing out to you?
I think we were watching earnings and looking for perhaps more of those cracks like you're talking about. And I think the thing that maybe surprised a lot of us was the fact that earnings were relatively solid. You know, banks reported either stable deposits, in some cases they increased. Banks reported basically kind of very either solid results or ho-hum results, but there were no outstanding, really horrible ones beyond First Republic's results, and a week later they were shut down, right? So I think surprisingly the sector on paper looks okay. It's just that the problems that folks have had with these stocks haven't gone away, and they also haven't gotten any reason to think things will be okay. If anything, if you thought that liquidity from the Fed and other agencies would keep banks afloat, now you're thinking that's not the case given that FRSC was shut down, and part of that was that liquidity was cut off.
Hey, Max, I am curious. We're just coming off our show with Joe Matthew, all things out of Washington. What are we hearing from Washington when it comes to concerns, continued concerns about the banking sector? Because I have to say, some of the conversation here at Milken, folks saying Silicon Valley Bank felt similar to the collapse of Bear Stearns, that from the Jefferies head of America's M&A, Chris Roop. Others are saying Silicon Valley and First Republic demise, just another check mark in the uncertainty box. So it does feel like momentum is picking up once again about some concerns here.
Yeah, in Washington, first of all, some lawmakers, specifically Democrats, are definitely unhappy about this deal that makes JPM larger. Separately, the FDIC put out a report this week talking about the sort of prospects for increasing deposit insurance, which is another kind of political hot button issue right now. So those are the kind of questions that are circulating. But I think to your point, people don't really know what comes next.
And something I was thinking about too, at what point would we call this a crisis? Because a lot of people have been calling this more banking stresses over the past month, but when we have obviously we're at the fourth bank now, so at what point do you think, I mean, are your sources saying it's a crisis, or is it still more of a stress? I really like that question, especially because this is the fourth bank I've seen described as idiosyncratic. And at a certain point, if four banks fail and they're idiosyncratic, it raises a question as to how unique they are. I think Jamie Dimon put it well yesterday. He called this, I think, a mini crisis or a micro crisis. Right. So I think it's definitely an issue. It's definitely an issue that hasn't gone away yet. But his point was that it does feel like we're reaching the tail end of it. And I don't want to, kind of weigh in one way or the other. But I do think we are seeing some arguments that this is kind of the last gasp of this turmoil, crisis, whatever you want to call it.
Well, on that note, we're going to leave it. We'll see what the guests here at Milken have to say. Max, thank you so much for checking in with us. Bloomberg News regional banks and insurance reporter Max Reyes on the sell-off that we are seeing in regionals. I do want to get to our guest. So excited that she's back with us. Let's get to it. Purnima Puri, she's Managing Director at HPS Investment Partners, large global private credit lender, head of liquid credit, portfolio manager for the multi-asset credit strategies. Why did they even let you come to this? Aren't you busy right now?
To see you.
And you're looking wonderful.
It's
great to see you. Help me make sense about what's going on in banking. I think we keep thinking we get through a calm period of 24 hours. How are you assessing it in your world?
A couple things. So I think one is, we were asked this question on the panels as well. So, in terms of trying to frame what's going on in the market, it almost feels like for some period of time there's been a QE feel to it.
Yeah.
Right? So equity vol has gone down, valuations have gone up, there's been infusions of liquidity, yet everyone's talking about a recession. So it seems a little bit tricky to square that. I would say when we think about the state of the world, we do think there's a lot of talk around recession, a lot of talk around hard landing, soft landing. I'm not sure it matters. Our view is that we're going to live in a higher rate environment for some sustained period of time. And now whether that's 5% or 4.5%, I'm not sure it matters. It's not 2%. And our view is that
no doubt about it, right? No doubt about it.
I don't think so. I think you'd have to have a really, really bad recession to have rates get pushed down that much. Okay. Which would not be good for credit spreads.
Right.
So we think that you're in a sustained period of higher rates. We think that you're in a sustained period of elevated inflation. and jobs have been good. So that means the labor market's still strong, and we're seeing it in corporates.
Is that kind of a thank God? Labor market is still strong.
I think it's strange.
Okay.
You know, the S&P as of a couple of days ago was up 9%, but the vast majority of that that number was a function of 7 stocks.
Yeah. Again, right?
Right. 493 stocks were flattered in.
Yeah.
In the S&P 500.
Yeah.
So anyway, so I think, sustained rate environment that's a bit higher, sustained margin pressure as a result of inflation. And so we think that, it's a little bit of a tricky market to navigate.
What's the smart conversation about Fed policy? We go back and forth, and I feel like the Fed's going to do what it's going to do ultimately when it meets. But what is the smart thinking about what the Fed says and does, in your view?
I think that I think the Fed's been very transparent, so I don't think my view is different than sort of what they've said, which is they're likely to raise rates. I don't know what time it is, right? But,
you still got a few.
Yeah, okay.
But are they right to, in terms of that inflation fight, do you think so?
Yeah.
At the risk of economic fallout or more?
I think they've said it. I think they're fighting inflation. I think that the job market continues to be strong. They've talked about one more hike. Maybe there's a second hike in June, maybe not. So I think that I'm not sure it matters that much on the margin. A quarter basis point doesn't really make a difference. I think the question, sort of the outlier questions that we're focused on and we don't have good answers to are impact of QT,
right?
Impact of debt ceiling, impact of federal deficit growing over time as a result of rate environments. So I think those are kind of the bigger questions and how that kind of plays into what the effective Fed funds rate looks like.
It's interesting. A lot of people have said, it's not about the debt ceiling. It's about the amount of debt that the U.S. keeps accumulating.
And the cost of that leverage.
And the cost of servicing it, right?
That's right.
And dealing with it. I mean, what could that mean ultimately?
The best thing I read recently was a Goldman report, and they sort of said, look, you're at a 6% deficit and you could get to a 20% deficit in 10 years because so much of that is the compounding impact of rates.
Right. So, yeah, but problematic.
Yeah.
Potentially economic slow. Okay, we know the scenarios. All right, so what are you doing in this environment? Where are the opportunities? Bad news, done.
So
there are opportunities.
There are opportunities. Credit equities, we think credit's far more compelling.
Yeah.
Within credit, we traffic primarily in corporate credit.
Which has been doing really well.
Which has been doing well. But by the way, equities up too, right? S&P's up 9%, high yields up 4%, loans are up 4%.
Yeah.
But within corporate credit, I think we would bifurcate it into investment grade high yield loans. Investment grade high yield, we think spreads are still tight.
Okay.
We think that, just a sort of fun fact is, over the last 10 years plus, 11, 12 years, since the GFC, GDP's grown at roughly 2 to 2.5%. High yield spreads were north of 500 over in that growth environment.
Wow.
And investments.
That's
great.
remarkable.
Yeah. So high yield spreads today are sort of 460, 470 over in a 0 to 1.5% growth environment. So we think that high yield spreads are not representative of sort of slowing growth, I would say.
Yeah.
We think the loan market at 600 over is sort of interesting.
Yeah.
Turns out 600 over plus a 4 to 5% base rate. That's a lot of carry, if you will.
Yeah. True.
And so depending on if those companies can navigate, earning 10 to 11% is a pretty good place to sit. Now that 600 over applies at 5% default rate. So, and I would say implicit in that is we don't believe the Fed's going to pivot quickly.
Yeah.
Because so much of that yield is driven by base rates.
But does that then lead to a lot more defaults ultimately? Folks on my real estate panel yesterday were saying, I think we're going to obviously see more problems, especially in the middle market space, but also talked about bankruptcies and company bankruptcies. I mean, I don't know. When someone says, on an M&A panel, SVB felt like Bear Stearns, or this is beginning to, you have Charlie Scharf saying, banks shouldn't be unconditionally required to kind of cover the failures of others. Like all of a sudden feels like the momentum is getting a little bit more negative. But is it just momentum which can change, or is it something more real?
So
kind of going back to the beginning.
I think sentiment is more cautious.
Okay.
I do believe that.
Enough to change actions. Investment.
Well, the question is, so you've already in credit markets, fund flows have been negative, right? So high yield and loan fund flows have been negative. There hasn't been a whole lot of issuance. So the market's been healthy and strong, somewhat driven by the rate environment, by the way, as well, right?
Right.
In terms of defaults, I think you asked the question. I think we're of the view that, could defaults increase somewhat? Yes. there's 200 billion plus or minus loan maturities in the next couple of years. I think that the bigger issue that we're concerned about is not as much maturities, because healthy companies, double B companies, they're going to get refinanced.
They're going to be fine.
They're going to be fine. I think we're more focused on there'll be, exchanged, there'll be a lot of liability management transactions. We've started to see those. Those can be pretty darn painful.
Yeah.
So that's sort of one bucket. And there'll be a bigger downgrade cycle, and that's already started. So there's so much dispersion in the market based on credit quality, and you're seeing that in our markets play out today as it is.
Does this cycle remind you of anything? I mean, we've gone through a lot, I think great financial crisis, dot-com boom.
I think what surprises me the most about this cycle is how spreads have remained tighter than one would think they should be. And I don't know if that's a function of there's a lot of money out there. People are of the view that companies can weather the storm, growth will slow, but maybe won't fall out of bed, and we're not going to have a hard landing, and there hasn't been a lot of supply. So there's a lot of reasons, but a lot of those reasons tend to be more technically driven than corporate driven.
Well, it's interesting in terms of, so then how much of the negative news, maybe minus the deficit and that stuff, is already factored in your view?
So I don't believe that much of it is factored into credit spreads, and I say that because credit spreads at a high yield at 470 over, while it's a good absolute yield, that absolute yield is 50% base rate driven.
Yeah.
And so I think that you got to get a little bit wider on spreads.
What gets us there?
To represent
potentially? Just all these things that you just, kind of the worry list, if you will.
Look, it takes time for a higher rate environment to flow through.
Yeah.
And it's early days still, and we're starting to see it.
Right.
I think
someone was reminding us yesterday, too, the same thing, that we're not there, folks, in terms of what the Fed's done and its impact, right?
Yeah, it takes some time. So I think over the course of the year, you're going to see margin degradation. Leverage numbers are still ticking up. Downgrade cycles are real.
Right.
And macro things around QT and debt ceiling. And by the way, what if, you have a lot of foreigners that buy treasuries, and there's a lot of high rates in a whole different number of sovereign regions now.
Right.
What if that money flows back to their own regions? So I think you have enough stuff floating that there might be some volatility that might push spreads out a little bit more.
But manageable?
I think so, because the truth is when you start at 8, 9, 10% in credit, you got a long way down before you're losing money now.
Right.
There's room for error.
One thing I wanted to ask you, because I know from some of the notes, we've got a couple of minutes left here. When you look at earnings that we've gone through so far, how has it been looking in terms of what we're seeing in the balance sheets?
I think it's a very mixed bag. I don't think there's a blanket statement. There's not a blanket answer to that. The S&P, for example, earnings were pretty solid, right? So people sort of, I forget the numbers now, like 70 or 80% of companies sort of either met or exceeded their numbers.
We've been managed well.
Yes,
Sorry.
No,
but that's fair. It's a metric.
Yeah, it's a metric. I think that in the levered credit world that we operate in, there's been a tremendous amount of dispersion in terms of numbers and outlooks. And I will say, in certain sectors, healthcare is a good example of that, and certainly in the world we're operating, we're still seeing labor costs are high.
Yeah.
They're really, really high. And so when you look at these numbers and you look at where margins have gotten hurt, it seems like it's going to be tricky, and it's going to take time for inflation to come through the system, or alternatively for top line to grow your way out.
Right.
And so we do think that things are going to be a little bit fragile.
Just got 20, 25 seconds. Do you think a year from now at Milken we'll be having a similar conversation, or will be more out of some of the stress? Just quickly.
I think time is your friend, and I think a year from now is a long time from now. So there's a lot that can happen in terms of sort of normalizing the world in a year from now.
Just look at like the last year, right? And stuff. Thank you. Thanks for your patience while we talked about the craziness in regionals. It's always good to talk with you.
You too.
Purnima Priori, she's Managing Director at HPS Investment Partners, joining us here at Milken, everybody. We're going to continue. Lots more guests to come. Carol Masser and just met, and you are listening and watching Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. Wall Street being rattled by a pair of high-profile regional banks. They are both selling off by 17% or more. We've got Western Alliance right now down 17.4%. Shares of PacWest Bancorp down now by 25%. Only a day after Wall Street was breathing a sigh of relief with the rescue of First Republic Bank, a sell-off in regional lenders is fueling anxiety over financial stability. Right now, the S&P is down 43. That is a drop of 1%. The Dow down 349, lower by 1%. We've got the NASDAQ Composite Index down 114 points. lower now by 0.9%. 10-year yield is at 3.42%, with the 2-year yielding 3.97%. Spot gold up 1.7%. 2016, the ounce West Texas Intermediate crude oil down 5.2%. Crude now 71.71 a barrel. While all of this a day ahead of the Fed decision, all eyes certainly on the Federal Reserve. They have begun their 2-day meeting. Are they going to be one and done? Megan Schreiber is Director of U.S. Rate Strategy at B of A Securities.
Our house view is that this will be the last rate hike of the cycle, but the Fed is still going to be in data-dependent mode. What's still most important to the Fed is inflation. They're still going to be monitoring the data that comes in.
And again, recapping S&P down 43, drop there of 1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening and watching Bloomberg Business Week live at the Milken Institute Global Conference. We're on YouTube. We're, of course, on our Bloomberg streaming service. First Republic's troubles, we thought that was all taken care of following the takeover by JP Morgan. We've been talking about the regionals today under a lot of pressure, which we know kind of complicates further the plan for what the Fed needs to do tomorrow at its meeting. We've been talking a lot about a credit crunch here at Bloomberg. So let's get to it, because our next guest is sure to have some thoughts. Armin Panosian, he is head of performing credit and portfolio manager at the alt investment manager Oaktree Capital Investments, roughly $172 billion in assets under management. Welcome. How are you?
Great. Thank you for having me here.
How's the environment, and what are some of the conversations you're having or wanted to have or ask people here at Milken?
Yeah, the Milken Conference has been quite balanced in terms of perspectives on investors as to whether they should be bearish or bullish. I think the consensus appears that there are more reasons to be cautious or bearish in the short term.
Right.
And probably optimistic in the long run about the U.S. economy. I think not enough conversation is had about the benefits of inflation in the long run, and I think some businesses and sectors are going to do well in the U.S. in the medium to long term.
Meaning what? The ability to raise prices, or what?
The ability to raise prices, inflation in a short period of time causes volatility in performance.
Right.
But in the long run, the dollars of profit of businesses that are strong and are able to pass through those cost increases with enough time results in an increase in the actual nominal dollars of profit when you actually do have inflation, which means that if you have fixed liabilities in terms of quantum,
right,
then you're able to repay those liabilities easier over a 3, 5, 7-year period. In the short run, obviously, with the higher cost of borrowing, there is an expectation of elevated default rates, though.
Well, let's talk about the implications of what we're seeing after the collapse of Silicon Valley and 2 other banks, and then First Republic, of course, of JP Morgan. We're seeing PacWest, Western Alliance, I'm sure people have been saying this to you, just really under a lot of pressure. How do you read it? Have we moved from it's just a few isolated banks, a crisis of banks, to a bank crisis?
I think it's very early in that process, unfortunately, for the banks. I think the behavior for especially some of the smaller and medium-sized regional banks is going to become more volatile and more pressured over time. We're seeing it in real estate initially. A lot of those banks are heavy borrowers in small balance loans and commercial real estate. There are leasing issues, there are completion issues, and I think that as those banks test the waters to see where they could transact in those loans, where they could clear a portfolio of those loans, they will find that opportunistic investors want cheaper prices than they're willing to offer,
So reset on valuations.
There will be a big reset, and there will be a hole in some number of those bank balance sheets as a result of that transaction.
That's what I was going to say. Who eats the reset? It says
it would be the banks, and then the question becomes whether their regulator, not all of them are Federal Reserve regulated banks, some of them are OCC banks, their regulators will have to decide which they allow to fail and which they save or plug the gap.
Armin, does it only get worse as, tomorrow's the Fed meeting, right? We are expecting the Fed to raise rates again. We'll see what Jay Powell and company have to say about monetary policy going forward. But they've also said we're going to keep rates high for a longer time. So that just exacerbates the situation.
It does. And if you look historically, when you have seen periods of rate rises, which haven't been many in the last 30 years, but if you look historically, usually it takes 12 to 18 months to feel the pain of that rate increase.
Same thing we were just talking about with our last guest.
And
reminding us it takes a while.
It takes a long time. And in fact, if you look at the pace of the SOFR curve, which we look at a lot in corporate direct lending, it's usually corporate direct lending is priced at a spread to SOFR.
Right.
SOFR didn't get to 4% until about September, October of 2022. So we're only about 6-7 months into that impact on the corporate direct
It's got to move up, right?
Well, the pain will be felt more and more and more as you do have sort of tepid growth and performance of businesses. A lot of businesses are challenged still in terms of their cost structures because of inflation.
Right.
And so the higher cost of borrowing for floating rate borrowers, like in real estate, like in some corporate direct loans, will create elevated defaults and issues in the next few quarters.
What does it mean for opportunities in terms of you guys? Right, you're known for looking for value.
Yes. Well, if you have dry powder, the investing environment over the next year or two is going to be more attractive than what it was in the past 5 years. Now, this is specifically about credit, not necessarily about equity.
Right.
I think actually credit probably outperforms equity in the next 3 to 4 years, and that's just not been true over the last 15 years of easy money. So I think when we look at our portfolios,
Because of the higher cost of credit.
Because of the higher cost of credit, yes. The lower cost of credit since the global financial crisis has really inflated a lot of asset bubbles,
right?
Including in private equity, technology, real estate, obviously. As you see rates rise and stay higher for longer and even persistently longer, like in multiples of years potentially, you should see a deflation of those same asset bubbles. And that creates an opportunity for, I think, well-heeled credit investors that structure debt appropriately, that invest conservatively, find less cyclical businesses or even counter-cyclical businesses. And with the banks stepping away and the regulators stepping in, it's creating an opportunity for private investors.
Is it just in banking where those asset bubbles will burst? I mean, in many ways, we've already had the crypto bubble burst. We're seeing it in regional banks. Is there real estate we're talking about? Is there something else? Potentially?
I think we're focused on the banking bubble. We're focused on the asset classes that are rate sensitive and therefore have benefited from that environment over the last 15 years.
Yeah.
Obviously, globally, there are going to be other sector-specific, commodity-specific bubbles possibly bursting for different reasons. But from a rate perspective, it's really a banking issue.
You guys recently launched a new fund, right? A private credit fund, about $10 billion. How are you putting that to work? How quickly are you putting that to work? Or, as you said, those who have dry powder. It sounds like you guys have a fair amount of dry powder.
We do have dry powder. In private credit, it's some of the best environments that we've seen today versus in the last 5 years.
So now the golden age, it's so funny because last year people were like, it's the golden era of private credit. I'm hearing it this year.
It was possibly a little early to call it last year, but this year, generally speaking, first lien, privately negotiated loans to companies that have a really large equity investment from a well-heeled private equity firm, they're yielding 11 to 13%, and appropriately capitalized and cash flowing, even with the high base rates out there. So, given that type of return profile, that type of support from an equity perspective, it is, I wouldn't say necessarily the golden age, but it's far better today than it was 3 years ago or 2 years ago even.
And that continues for a while because we still haven't felt the long runway or the runway of the Fed moves.
I think it does continue for a while for a few reasons. One, I think the banks have taken a step back, just given the well-publicized.
You guys see it directly, right? As
the
banks
course.
Right?
Oh, of course. I think the only thing saving the publicly traded bank loan market from really moving step changes down is that there hasn't been a lot of new issuance.
Mm-hmm.
LBO deal volume is down, so the banks are kind of not needing to put out capital in support of private equity activity. And that's creating a balance in the market that has resulted in prices of broadly syndicated loans staying near par. But I think if there was a sudden need for capital, the banks would have a tough time placing it. And as a result, the direct lending environment, the direct lending competitive set is more actively engaging with private equity sponsors on providing them very, very sizable solutions.
I just said you've got this new fund, $10 billion. It's a lot. Is it the possibility, if it's so opportunistic, that you guys could do another fund, or because there's so much out there?
Yeah, I mean, based on what we're seeing in the market, we think we could deploy that capital in a very responsible way over about a 2 to 3 year period.
2 to 3. Okay.
So beyond that, it's hard to know. My crystal ball is it's decent, but it's not.
You're like, let me just put this to work.
Yeah, I'll focus on this, and I think it's going to be a great vintage.
But it's all going into finance banks specifically.
It's all going into financing, mainly leverage buyout takeovers of businesses.
Okay.
Really stepping in where the banks are stepping away.
What, and just got about 20 seconds, 25, is it certain industries or it's across section?
It's sector agnostic, but there are certain industries that just underwrite better using our very conservative underwriting methodologies, things that are less cyclical, less commodity sensitive, and not retail sensitive. So we like, we like life sciences, we like healthcare, we like certain types of aerospace and defense businesses, industrials, consumer non-discretionary products.
And you're busy.
Very busy, looking at a lot of different types of deals, it's an exciting time for credit right now.
Interesting. I'm so glad we could get some time. Thank you.
Thank you so much. Good to chat with you.
Same here. Armin Panosian, he is head of performing credit and portfolio manager at Oak Tree Capital Investments here at Milken. All right, off to D.C. we go and check on world and national news. Nancy Lyons in our 99.1 newsroom. Hey, Nance.
Thanks, Carol. The Biden administration is planning to send 1,500 troops to the U.S.-Mexico border amid an expected migrant surge after pandemic-era restrictions are lifted next week. White House Press Secretary Karine Jean-Pierre.
They will not be performing law enforcement functions or interacting with immigrants or migrants. This will free up Border Patrol agents to perform their critical law enforcement duties.
Again, White House Press Secretary Karine Jean-Pierre. The Surgeon General is issuing a new warning about loneliness.
Dr. Vivek Murthy says about half of adults in this country experience isolation from friends and family. His advisory says that raises the risk of depression, anxiety, and even heart disease, stroke, and dementia. The Washington Post reports the Surgeon General is calling for a collective effort to mend the nation's social fabric. That means teaching kids how to build healthy relationships, talking more with relatives, friends, and coworkers, and laying off social media if it cuts into face-to-face interactions. In Washington, I'm Nathan Hager, Bloomberg Radio.
The nominees for this year's Tony Awards, honoring the best in Broadway, were announced today on CBS Mornings. Here's Funny Girl star Leah Michele with the nominations for Best Musical.
And Juliet. Kimberly Akimbo. New York, New York. Shucked. And Some Like It Hot.
The winners will be announced June 11th. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long. The Dow, the S&P, NASDAQ in the red, down by 1.1% or more. Regional banks, very much a source of concern today for investors. But let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlotte. U.S. stocks trading off their lows, but still under pressure. And like you said, it's about those regional banks. Those worries continue. Dow's currently down 363 points, was down 615. S&P's dropped 45, while NASDAQ is down by 122. The U.S. 10-yield falls to 3.42%. Gold is surging up 32. Oil is sinking, and Bitcoin is trading higher by 4.3%. Of the main 11 SB sectors, only consumer discretionary was in the green, and leaders to the upside, the Dow, Merck, and J&J, while Chevron and American Express fell 4% and led to the downside. Regarding those regional banks, PacWest plunged as much as 42%. Western Alliance sank as much as 27%. And in other news, Icahn Enterprises plunged 20% after Hindenburg Research said it was short. Wrapping things up, some of the names pointing after the bell tonight include Clorox, Ford, Prudential, and AMD. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. We're going to be busy. We've got you covered on those earnings. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just under 18 minutes left in today's trading session. It is time for the Drive to the Close. Carol Massar live at the Milken Institute Global Conference. We've just met back in our studio, but so delighted to have with us on this Tuesday Chris Ailman, Chief Investment Officer at CalSTRS, some $300 billion in assets under management. I think more than that. California State Teachers Retirement System. You know, it's the largest teachers retirement system, second largest public pension fund in the nation. Chris here at Milken. Not too much pressure that you have to manage all that.
And we're sailing to the close, not driving. We're sailing.
Chris and I, before we got started, were like talking sailing, and then we were also looking at what PacWest and Western Alliance are doing. I mean, I got to start there. The regionals. How do you factor that in? Is that opportunity for you when you see some of these names getting beaten up, or do you say too soon, too early?
Distressed sellers. I'm more interested in the assets that they have to sell to raise capital. We spent a lot of time this weekend talking to different companies that were going to bid on assets.
For First
I'm
Republic?
concerned.
For First Republic?
Might be.
Sources say.
Go unnamed.
Come on, Chris.
But we didn't win the bid, so it's safe to talk about. But the
because the underlying assets were good.
Parts of them were good. Okay. And anytime that you have a distressed seller, you know, if somebody's selling, then you want to buy. If they're buying, you want to sell.
Right.
It's the old Warren Buffett adage. So I'm concerned that the regional banks are getting hit one after the other. I mean, these two banks I've heard names of, but you and I were discussing, I didn't even know where they were located. I'm surprised that we're having more contagion. We just had Citicorp's CEO here at Milken yesterday say, and JP Morgan's representative say everything is fine. That was it. First Republic, and we should be done. Now we have other names. The regional banks are under pressure, but it's more almost a flight of fear and seeing capital flow out.
So tell me what you're doing in this environment. You got a lot of money to put to work.
We are very neutral. We have been defensive. We have been anticipating a tough economy almost for 9 months, and we've been wrong because it's been muddling along. And I really believe so many people are expecting a recession to come up. That either it's going to be a self-fulfilling prophecy in the most anticipated recession in history, or maybe we will just muddle along. It's hard to say that the Fed's going to pull off a soft landing, but the Fed will probably stop tomorrow, after tomorrow, or shortly. They're not going to pivot.
Yeah.
But we may have almost the worse than a recession, just a slog for up to 2 years. No growth, 1 to below around 1% growth.
Yeah.
It's good unemployment, so good employment, strong market, but an equity market that's going sideways.
So, okay. So what are you thinking about? Like, I was reading some stuff about you specifically, and while VC is not something that you guys have big exposure, you've been looking at some stuff, though. Is that fair?
We have. We've always been trying to. We have very strong disclosure laws in California that make private equity, and then specifically venture capital, a real challenge.
Yep. Yep. Do you wish you could do more?
Oh, yeah, without question. Silicon Valley is right in our backyard. We absolutely wish we could be a major player. They would rather take money from sovereign wealth funds that don't ask any questions than from a California public fund that asks a lot of questions and wants to know what it owns and how they invest and what their fees are and want to negotiate fees. Those other ones are much more happy to take the money. So it's, for us, we're interested in private credit. I have stated that we're very worried about real estate, particularly the office market, Class B and Class C. Thankfully, we have a wonderful office portfolio with long tenants and good quality debt.
Seeing no stress, no problems, no worry.
No, but the price is just simply because the Fed went from 0 to 500 probably tomorrow in 9 months, 10th straight raise, unheard of since the 70s. That's got to cause damage more than just Signature Bank and Silicon and First Republic. So
let me ask you about real estate. You talked with the FT recently, getting ready to write down the value of assets in your real estate portfolio. This, I guess it said $52 billion real estate portfolio. Is that the case?
Well, we sat down with our real estate consultants, and just simply because the Fed has moved so quickly, cap rates have to go up, which means real estate values have to come down. And so we were just already anticipating. I have a very educated board that asks really good, tough questions, and that was their question: what happens to our office portfolio? Nobody's fully back in the office. How do you figure out values? There are no transactions. The conclusion was we would expect write-downs in the office portfolio.
Write-downs, but not defaults, or no?
You're going to see defaults, particularly in the Class C and Class B properties.
But you're not there.
And we would be probably interested in being a buyer if you could upgrade some of those. But I think that area is going to be distressed for a long time period. And you're right, I'm more concerned. We're fine. We have Class A and fully leased. But what I'm looking at is who owns the paper behind those defaults. Will we go back to a pretend and extend environment like we used to see with the banking regulators? Because, they want to solve what we're having, this banking crisis.
Chris, I do want to ask you about bonds, too, because from what I understand, you guys have been moving into increasing your bond investments. What specifically?
Hey, for the last 30 years that I've been a CIO, bonds have been decreasing in the portfolio because yields have been coming down. They bottomed and bounced. And so for the first time, fixed income has a return. Cash has a return, so we're going to slightly start increasing our fixed income allocation.
Short duration, or?
We will extend out the curve, because even when it's inverted, that's probably a good time to buy some duration, to buy some longer dated. We like private credit.
Can I just ask you, who doesn't like private credit?
Oh, good Lord, that's the thing that worries me. Everybody wants to go in.
Thank you for saying that, because I sometimes feel like 3 years from now we'll be at Milken being like, we all missed it in private credit. Like, no, but I do wonder.
No, there's too much money flowing in.
It's a lot.
And it's all about credit analysis. But it's simply because the banks completely stepped out due to the change in regulations. So
But is there enough oversight of private credit?
I think you have sophisticated investors who are doing it. There will be some defaults, especially if we do have a recession. Then some of those companies, some of those covenants. But a lot of it is collateralized, short-term loans, variable rate loans, so they float, which gives you an opportunity to get a decent yield and return on your capital. The problem for me is you have to then turn around and redeploy the capital. A lot of people love that, but for me, I need to make a long return over 30 years, so rolling money constantly is a challenge.
I just got 20 seconds. You got an equity thing, in the equity area that you like?
I am still very cautious on equities. I'm shocked at Europe, but the U.S. market, from Milken a year ago, the U.S. market is basically flat, and I think, unfortunately, we're going to see that going forward.
It's an interesting time. Another one, right?
Always.
Good for the book, or for the trip when we're sailing or something. I don't know. Chris Ailman over at CalSTRS, Chief Investment Officer. Chris, thank you so much. Pleasure.
Pleasure.
This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pelletfield. 3:53 the time right now on Wall Street. We're keeping an eye on those regional banking shares ahead of the close right now. Shares of PacWest Bancorp plunging 27%. Western Alliance Bancorp down now by 16.1%. KBW Bank Index down now by 4.4%. Uber shares are rallying. Shares of Uber, based in San Francisco, up 11.6%. The company reported earnings that beat analyst estimates, showing that consumers continue to spend more on rides and food takeout despite an uncertain economic outlook. Uber CEO Dara Khosrowshahi spoke this morning with Bloomberg.
The fact is that the mobility marketplace is growing. People are going out more. They're going to restaurants. They're returning to work. They're returning to the office. We are definitely seeing those tailwinds. And I wouldn't be surprised if Lyft does too going forward.
And again, he mentioned Lyft. That stock up 0.2%. Crosstown rival based in San Francisco. Uber again up by 11.6%. Chegg shares are plunging after the company said OpenAI's ChatGPT is threatening the growth of its homework help services. Shares of Chegg gets its name from chicken or egg, down 48.8%. So right now we're looking at a down day on Wall Street. Uber, as I mentioned, pushing higher. Marriott also higher among travel names after reporting earnings. Shares of Marriott, they're up now by 4.9%. Those are the company stories we're following, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
I'm Jess Minton in the Bloomberg Interactive Brokers Studio. Carol Masser will be along shortly from the Milken Institute Global Conference in Beverly Hills, California. Now, let's get a check on the markets in top business news with Charlie Pellet and a Bloomberg Business Flash.
Thank you very much, Jess. Here's what's going on. We got 5 minutes to go until that closing bell clangs on Wall Street. Here are the numbers. Keep it locked in for our coverage at the top of the hour. S&P down right now by 45, drop there of 1.1%. We've got the Dow lower by 353 points, a decline there of 1%, and NASDAQ down 124, lower also by 1%. Cannot ignore the regional banks. A lot of this having to do with sentiment today. Certainly frazzling nerves on Wall Street. We've got PacWest, as I mentioned, down 28%, and Western Alliance Bancorp down now by 16.1%. 10-year 3.42%, with the 2-year 3.97%. Gold up 1.8%, 2017 the ounce. Bitcoin up 3.7%, 28,713. And crude, a story that's getting lost in all the news today. West Texas Intermediate crude down 5.3%, 71.61 a barrel. Lots of moving parts to today's market, and that just meant is a Bloomberg Business Flash.
Thanks, Charlie. Now, I'm going to point out something that we do have for our U.S. equities team. We have an earnings watch that we put out every day during earnings season. And I wrote one today that was looking at the forecast when it comes to earnings season and how they're signaling an end to a profit recession, and how that's near. And I was looking specifically at how the earnings revision momentums for the S&P 500 and actually measures the direction of these when you're looking at the net revision momentum for the S&P 500 on a 12-month forward basis. That's at the highest it's been in over a year. So it's basically telling us when we are looking at the outlooks for S&P 500 companies, they are coming in better than expected, but obviously the caveat being the trajectory of the Federal Reserve rate increases and obviously inflation. We will hear that decision from the man himself, Fed Chair Jerome Powell, tomorrow afternoon. If you're looking now under the hood for the S&P 500, 10 of the 11 sectors in the S&P down, led by those declines in energy. And Charlie was just talking about obviously those crude prices being down lower. So obviously that pressuring, and looking at just 19% of the stocks in the S&P 500 are higher. Now let's go back to Carol and Romaine Bostic from the Milken Institute Global Conference. Our cross-platform coverage Beyond the Bell starts right now.
Bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Carol Masser. We're counting you down to the close, and we're doing it live from the stage at the Milken Institute Global Conference in Beverly Hills, California. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks, Carol Masser, streaming on YouTube.
Oh my God. You know, you and I were talking before we got started. It does feel like the tone here at Milken has changed.
Yeah.
And maybe it is, you know, the focus on what's going on in regionals in the markets. They're just getting decimated. You know, PacWest, we're talking about Western Alliance. Chris Alma of Cowsters was just on with us, and it was funny from his perspective. He's like, well, wait, who are these banks?
Yeah.
This guy oversees, what, more than $300 billion in assets.
Yeah.
And just how these unknown banks can really unnerve, if you will, investors. It's pretty remarkable.
And it unnerves a lot of investors, and I think we heard this from Larry Summers, the former Treasury Secretary on Bloomberg Television, talk about this idea of sentiment, confidence, right? So it's not so much the contagion is whether you have any money directly tied to any of those banks. It's about the broader concerns about, can I really trust the system? And a lot of this isn't just about the banks. It's about trust, or rather the lack thereof, in regulators.
No, absolutely. Exactly. Chris Hellman also talking about that, this concern about sentiment and whether it's about the financial system, but even talking about sentiment when it comes to a recession. He says, who knows if we're going to hit a recession? We still have a job market that kind of moves along, if you will. But do we talk ourselves into it? And Romaine, it's something that we often talk about. Sentiment can get us there.
Well, do we talk ourselves into it? Does Jay Powell talk us into it? I mean, he's been talking about this for a while. We're going to hear from him tomorrow.
Right.
I know there's going to be a lot of discussion about the banking sector and how the Fed is addressing it, but regulators broadly, but also how that affects their outlook for monetary policy.
I am curious to see if it affects them in any way. We're all expecting a quarter point, but we'll see.
Yeah, and I think the fact that you look at all the red on the screen that we're seeing here today, the idea that people are really rattled in public markets and in private markets too. They may not admit it as loudly as you're seeing in the public markets, but it's certainly there. Let's get a quick check here on the closing bell. Scarlett Fu back in New York has a read.
Yep, we're down more than 1% across the board for the Dow, the S&P, and the Nasdaq, and it is a broad retreat here with more than 4 stocks lower for everyone that is up on the New York Stock Exchange. Volume is also up. It is up 30% from the 10-day average. And when you look at the sector performances, yes, this is a broad sell-off, but what's notable are the outperformers here. And you're seeing a lot of consumer-related companies hold up pretty well. Retail and consumer services are both two sectors that actually finished in the green, up by 0.5% at least. And that speaks to the consumer strength that we've been seeing across the earnings landscape. The consumer seems to be holding on, even as they are paring back some of their spending. Now, on the downside, energy stocks down by more than 4.2% at the moment here, as crude oil fell below $72 to a 5-week low. Banks, of course, getting hit hard as JP Morgan's purchase of First Republic, its assets, its deposits, has not calmed things down completely, with PacWest and Western Alliance losing more than 20% each. And of course, we are awaiting Ford earnings as well as Starbucks earnings, and we'll bring those to you as soon as we get them. Romaine and Carol?
All right, thanks, Scarlett. Great wrap up there. And I'll just add to Scarlett's market check there. I thought the moves that we saw in yields today, at one point, the 2-year yield was down more than 20 basis points. I think at the end of the day, maybe only 15, 16. But the idea here of how much is being repriced into this market.
Again.
And being, again. Yeah, look at you. You're front running me again. I'm the one who's supposed to interrupt. But really,
in your mind.
But really, I know you're like here face to face, so I can't really, I don't have the power over you like I used to. But in all seriousness, the idea that people don't know what is price discovery in a market where a 2-year yield, the safest debt instrument in the world, more or less, can move like this on a day-to-day basis.
Talk about something crippling. When you don't know the valuations of something, when you don't know how to price something, then what do? You hold back. And that's what we could potentially see. You talked about private credit before Scarlett did the numbers. I mean, private credit is everywhere. That's what everybody seems to talk about it. Talking with Chris Allen again, like I said, what's the transparency in private credit? Do we need to be worried about the growth there? What's the oversight of that? So I don't know. Maybe that's...
Well, that's another conversation. I mean, you're not going to necessarily get an honest answer out of some people here.
No.
But there is a bigger issue here about the systemic risk baked into that, because you don't have the transparency. No. It's easy for them to say, we're long-term investors. We don't need to mark the market. If things are sour, we can ride this out. Can they?
I don't know.
We were talking with Victor Kozla a little bit earlier. He was talking about this idea that this could be sort of a prolonged, maybe 3 to 4 year sort of down cycle. And there are a lot of companies that aren't built to survive that long for 3 to 4 years in a down cycle.
We're going to catch up with him. I love how he says, distressed investor, but he also is calling himself like an opportunistic investor in this environment.
Yeah.
One man's pain is another man's gain, and we do see that in the investment cycle. But I feel like there's too many questions out there. The wall of worry and the things that we as investors have to think about, it's a lot right now, and it's hard to figure it out.
Yeah, absolutely.
No, go ahead.
Yeah, I was going to say the sentiment here in Milken, different than what we saw last year.
Absolutely.
Some of the same issues were here last year, but I think there was a sense that, this will pass, this too will pass. 1 year later,
we're not there
the
yet.
Reality is we're not there yet.
Yeah, exactly. A lot of good stuff. I mean, I was just looking at some of the comments here. Someone saying Silicon Valley Bank, this was an M&A panel, saying it felt like Bear Stearns, the collapse of Bear Stearns and the great financial crisis. Yet others saying that, Silicon Valley Bank and First Republic, just another check mark in the uncertainty box. So these things continue to plague the thinking here, and it's pretty fascinating. I mean, yes, everybody's saying there's opportunities, but I just feel like there are just so many questions out there.
I do want to go back to the Bear Stearns thing, because we spoke with Ann Walsh of Guggenheim on Monday.
Yeah.
And she made this point, the idea that everyone's looking for that Lehman moment, but you sort of forget the timeline of how we got to Lehman. Bear Stearns in early 08. I was working here at Bloomberg when that happened. And then, of course, it wasn't until the fall when you got Lehman. That was a long lag in between here. And I think that's what's causing some concern, right? People wanted a quick resolution to this. Yes. Even coming into Monday with the sale of First Republic. Okay, done.
Right.
But what? Is the book done or just the chapter in that book?
I don't know. It was less than 24 hours that we started to feel some uncertainty, right, about the other regionals as you saw them sell off. And I think it's so interesting. If you think about a week ago, we were going through, or 2 weeks ago, going through some of the big tech earnings, we were feeling, all right, some of these reports came in strong, starting to feel some optimism. And then here we are once again talking about the regionals, and it's definitely dampening investor sentiment in a big way. And there's momentum behind that trade.
Well, most of the people in this room are much more focused on the private world. I did ask them a lot about earnings in the public space and what we've heard out of some of these companies. And I think we have some earnings actually crossing the wire right now on the Bloomberg terminal. Scarlett, I think, has it for us. Scarlett.
That's right. We're hearing from Ford, and Ford has reaffirmed its full-year EBIT view for its different business segments. And of course, it just changed its business segments. It's no longer reporting according to region, but according to Ford Blue, which is its legacy business, and for Ford Pro, which is its commercial and government customer business, and for Ford Model E, which is its EV business. And there it is reaffirming its full-year view. In terms of first quarter adjusted EPS, 63 cents was the reported number. The consensus estimate was for 42 cents, so much better than expected. And you can see the stock moving up by 0.7%. For the full year, Ford says it sees full year adjusted free cash flow at $6 billion. It had previously also indicated it would see about $6 billion in free cash flow. So that is pretty consistent. And so no new news there. And in terms of full year adjusted EBITDA or EBIT, no duh, $9 billion to $11 billion. The consensus estimate was $9.5 billion. Let's move on to Starbucks right now, because that stock also reported, that company I should say also reported, adjusted EPS for the second quarter, 74 cents. That is 9 cents better than the consensus estimate of 65 cents. Revenue in the period, $8.7 billion. Analysts were looking for $8.42 billion. So better than expected on the quarter that just ended. In terms of the breakdown, international comparable sales up 7%. Analysts were looking for 1.5%. Of course, China is a key part of this international business. And in China, comparable sales rose 3% when the consensus estimate was for a drop of 10%. Of course, China coming back online, the economy reopening after those 3 years of COVID restrictions. Comparable sales for Starbucks rising 11% in the period. The estimate was for a 7.3% gain. Nevertheless, you look at Starbucks shares, they're dropping right now in after hours trading. I'm going to send things back over to you as we figure out what's going on with Starbucks stock price. Romaine?
That makes sense. Those numbers look fairly strong for Starbucks.
Well, they look very strong. You talk about what was 11% growth or something, but the idea here that investors aren't looking just for growth anymore.
No.
Let's be clear about that.
I think you're absolutely right. And one of the other concerns is, wage costs have gone up. That's certainly going to compress margins. There's some concerns about that. They're looking at cash flow, balance sheets.
Yeah.
So even if you see some outperformance, it's not enough for investors.
And what are investors interested in right now, right? Like if you look at the economic environment, do you go after a consumer company, like a mature consumer company to be sure as well, or do you go for something maybe a little bit different that offers you maybe a little bit better cash flow?
I don't know. I think, well, maybe, but I think people are looking for safe, less risk.
Is Starbucks safe? I know you're addicted to Starbucks. How many Starbucks drinks do you drink a day?
I drink like the office coffee, buddy.
Office coffee?
I make coffee in my, hotel room.
You can finish that thought. It must not have been good, which is why you paused.
I don't know. I think what's interesting is you have an environment where people are also talking about look for dividends. Like that's a safer play.
Yeah.
Apparently,
Carol Massar needs a cup of coffee.
Apparently, I need more.
I think we're supposed to wrap Carol Massar.
All right, that is a wrap. That'll do it for Romaine and I. Catch us again tomorrow at Milken, same time, same place. We'll be on all our platforms. We'll see you tomorrow.
You're listening to Bloomberg Business Week with Carol Massar and Tim Stenevec on Bloomberg Radio.
I'm Jess Mitten in the Bloomberg Interactive Brokers Studio. Carol Massar is at the Milken Global Conference in Beverly Hills, California, and will join me again in a moment. First, let's go back to Charlie Pellet with a Bloomberg Business Flash.
Hi, thank you very much, Jess. Here's what's going on. Dow, SP, NASDAQ, end of the day in the red. Regional banks very much in focus today. They ended with steep losses. Steep defined as 27.8% on shares of PacWest Bancorp. Western Alliance, another regional, very much in focus today. today. It was down 15.1%. Sell-off in regional banks certainly rattling investors. Earnings, you guys talking about that. Right to the numbers here. Ford, it's reported first quarter adjusted EPS of 63 cents, estimates 42 cents, reaffirmed its year forecast, but after hours, I'm looking at Ford shares, they are down now by 2.6%. Starbucks after hours, down now by 1.1%, has been bouncing around. Starbucks second quarter comp sales up by 11%. Estimates were for 7.3%. Lots of earnings after the bell. AMD as well. We got you covered on those. S&P today down 48, drop of 1.16%. The Dow today down 367, down 1.1%. Nasdaq down 132, drop there of 1.1%. 10-year yield 3.42% with a 2-year below 4%, 3.98%. Bitcoin rallying 3.6%, 28,679, and gold up 1.8% at 2017 the ounce. Don't want to ignore crude oil today. Big move there. West Texas Intermediate crude here in New York down 5.4%, 71.75 a barrel. So again, recapping here, the Dow, the S&P, Nasdaq finishing off session lows, but still very much in the red. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you, Charlie. This is Jess Minton in the Bloomberg Interactive Broker Studio. Carol Masser is going to join us once again from the Milken Institute in Beverly Hills, but I'm going to give you another quick business flash update here when it comes to after-hours movers and earnings, in particular, looking at Starbucks. That's ticker symbol SBUX. Shares down more than 1%. The company did report comparable sales that did beat estimates, particularly in the second quarter. It beat the average analyst estimate, but you are seeing those shares pressured. Also looking at Ford, that's ticker symbol F, that also down after hours by about 1.5%. That's ticker symbol F, and it did say that its first quarter adjusted earnings per share was about 63 cents. It did beat the average analyst estimate of 42 cents, but I hear that Carol is back with us in Beverly Hills at the Milken Institute, so I'm going to throw it back to her. Carol.
All right, Jess, so appreciate it. Yes, indeed, everybody. I am live at the Milken Institute Global Conference. We're on YouTube and, of course, Bloomberg Originals. And I got to say, 1 month ago on a Bloomberg podcast, our next guest noted that aggressive rate hikes from the Fed and the ECB were creating tighter financial conditions and more opportunities for distressed investors. This is from Victor Kosla. He's Chief Investment Officer, founder of Strategic Value Partners, roughly $17 billion in assets under management. Welcome, welcome. So nice to have you here.
Thanks for having me.
I have to say that Chanali Bosick, who you know well here at Bloomberg, we ran into you yesterday, and I think she said you're a distressed investor, and you said something else. You said opportunistic.
Yes, I said I bridle at that description, distressed.
You're not, your website says distressed. No, so tell us about this environment, because we're on a day, Victor, as you know, where once again the markets are rattled. The equity market specifically, I should say. Regional banks plummeting. We saw some volume behind it. How do you kind of look at this scenario, this environment, and what's going on? And does it potentially get worse? First of all, let's start there.
Since the Fed started to hike rates, since the Ukraine war about a year or so ago, Carol said the markets have been grinding down. And the Fed is still raising rates. The ECB is a year behind the Fed, possibly. Inflation is just peaking out there. So I think to our point of view, as we kind of look forward right now, we think this is just the early innings of kind of a credit cycle. Now, are we going to? Is this of a
bad credit cycle, tight credit cycle?
A bad credit cycle.
Yeah.
Right. I think as we look at the world today, we can all have a debate. Is it a soft landing? Is it a recession? We at SVP, we believe it's a recession. But I'll tell you what, put that on the side for a moment. 30 years I've been investing in opportunistic credit. 30 years. I've never seen a cycle where the Fed was the headwind. Every cycle we've had over the last 30 years, you hit a bad cycle, the Fed starts to lower rates. To
ease it.
Yes, to ease. Because the ECB is even more dovish, right? It starts to, and it's lowering, it's increasing rates at the same time.
Right.
So I think to our point of view, these higher rates, these slowing economies, regardless of what happens, soft landing or a recession, they are creating an environment where people are starting to have problems servicing their debt, much higher rates today, and those problems we think just continue to now cascade. Our view, and please, I don't think I'm being overly glum or so on.
Yeah.
I think most people would say, look, the next 5 years, even your classic analyst would say next 5 years, slower economic growth than the last 5.
Yeah.
I
heard people talking about 1%. Chris Elman over at CalSTRS, 1%.
Yeah, so you get slow economic growth, you get much higher rates, and oh boy, and by the way, all this stuff with, First Republic or Silicon Valley Bank, in the overall scheme of things, it's just a little bit of noise, right?
Yeah.
Right?
Does it get louder, though, with something else? Like office properties?
Office is not just going to get louder, it's going to boom. You'll hear that sound.
Yeah, it'll
right?
be that bad. Even top-tier properties, in your view?
So can I tell you, let's just talk about office, right?
Yeah.
If you look at office today, New York City, center of it, 35% of all mortgage debt on offices in New York City, 20% vacancies. You want to rent space in office today? Effective rents are net effective rents after TI, after CapEx are 30% lower. You put that into your model, you're talking about a 50% decline in office values. So 50%.
It's dramatic.
Right? Yeah.
That's a boom.
Yeah, and so this won't be some soft noise.
So what does this mean for you guys? What do you do? You got, from what I understand, Bloomberg did a story about a $1.5 billion fundraise, right, for opportunities, maybe a target of close to $4 billion. Is that the case that you're putting to work?
I can't talk about fundraising. You're going to forgive me.
Okay, that's fair. But tell me, in terms of the specific opportunities that are coming before you that you want to commit capital to or invest in.
So like take like a lot of 2022. As this opportunity changed, we slowed down. By the way, Carol, can I tell you something? People always love to talk about, hey, what a great opportunity. The first 6 months of 2022, our focus wasn't like, what a great opportunity developing. The first half of 22 was, how much trouble are we in? Right?
It was.
Yes. So because, we all have portfolios.
Yep.
And you kind of look at them now through all these eyes of the coming issues and the coming downturn in credit, and you make sure that what you have is solid, right? That's the first thing we did as an investor. And then in the second half of 2022, as we were looking around at opportunities, look,
we only have about 20 seconds left.
Okay.
So let me just...
Can I just finish on one
Yes,
thought?
please.
All right. This is early stage.
Okay.
We invested $1 billion or so in the last 9 months of 2022, and we've invested $1 billion in the first 4 months of 2023.
Wow.
Normally, we would be investing $2 billion in those 4 months, right? So it's starting.
So stand by.
Yes.
Victor Khosla, thank you so much. Come back. I'd love to continue this.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets for you all day long here at Bloomberg. I'm watching shares of Advanced Micro Devices after ours just reporting earnings. They're down now by about 1.5%. AMD, the headline from the Bloomberg, sees second quarter revenue in the range of $5 to $5.6 billion. The estimates have been for $5.51 billion after ours. Advanced Micro Devices trading lower now by just about 1.5%. Also out with earnings moments ago, Starbucks. It posted sales that beat estimates as transactions increased, a positive sign for consumer spending. Performance in China also outpaced Wall Street's expectations after ours as we run the GIP function on Starbucks, down now by just about 2.4%. Down day on Wall Street today, red on the screen, regional banks front and center. A lot of anxiety there. Just a day after the rescue of First Republic, shares of PacWest Bancorp down 27.8%. We had shares of Western Alliance Bancorp down by 15.1%. Bottom line, stocks sold off with the S&P down 48, down 1.2%. The Dow today down 367, down 1.1%. NASDAQ down 132, also down by 1.1%. 10-year yield 3.42% with the 2-year 3.98%. Spot gold 2017 the ounce up 1.7%. And West Texas Intermediate crude oil down 5.3%, 71.65 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I'm Carol Masser. I am live at the Global Institute, Milken Institute Global Conference here in Beverly Hills. And we have a great guest with us, Ida Liu, Global Head of Citi Private Bank. She's a member of the Global Wealth Management Leadership Team there. So good to be here with you again. You were saying it was your 7th year at Milken.
Yes, it is.
I don't know, do you go from year to year? And the pandemic was certainly an interesting time. And I don't know, how do you kind of compare it to last year in terms of some of the conversations, the worries? We're still talking recession. I don't know, give me an idea.
Well, you know, it's interesting because the energy level here is incredibly high. We've had a huge amount of people here at the conference this year. It seems a lot more attendance.
It's like what pandemic
past.
Finally?
Yeah, exactly.
Finally.
Back to sort of BAU pre-pandemic levels of attendance. And it's really wonderful because we are talking about so many topics that are on everybody's minds. You know, everything from geopolitical risks, how to invest, how to navigate the capital markets, is there going to be a recession, all the way to topics like environment and healthcare and gender equality.
Here.
I love the cross-section and the intersectionality of all the different topics as well. Like, very important.
Well, it is funny too that we're, we're going to talk recession, and I want to get your outlook. The concern again about regional banks, because it felt like things had calmed down yesterday, and then we looked at things like Western Alliance, PacWest today, and again there seems to be nervousness back in the market. And I do feel like the tone changed a little bit from yesterday here at Milken. How do you see it? How do you factor it in? And also the concerns about commercial real estate, like that's kind of the next leg.
Yeah. Well, look, I think we need to let this situation play out over the next few days. I mean, we're super confident.
Do you think it's just the next few days?
Well, let's see. Let's see. But we're super confident, and that doesn't change our conviction in our banking system, the health of our business. We are one of the most global banks in the world. We're a globally, systemically important bank. We have diverse sources of revenues from different businesses around the world, and a very, very strong balance sheet. So from our perspective, you know, we're obviously still in very good shape and looking to make sure that we're helping our clients and advising customers.
It's good to be a big bank right now. I say that with, all respect. When you look around the world, though, U.S. versus, let's say, outside the United States, and I hate to just do those big buckets, Europe, Asia, tell us what you're seeing.
Well, you know, it's interesting because when you look at the emerging markets, they're trading at about a 40% discount to the U.S. And you think about where the U.S. has come over the last decade. It's been a bull market, as you know, right?
Absolutely.
And so the question becomes, how do you achieve the growth in the future? Is it going to be from the U.S. or is it going to be emerging markets? And we think it's a balance of making sure you have a global, diversified portfolio, especially with some of the emerging market opportunities.
Yeah.
And
it's funny because I do feel like there's some momentum around emerging markets again. Like for a long time, everybody had kind of forgotten it, but it does seem, is it some of it maybe dollar weakness to some extent, or what is it?
Part of it is dollar weakness, and the other part is the split and the ongoing bifurcation of the United States and China. And that G2 bifurcation is creating a lot of opportunities for investors around the world, right? Because as China is growing and continue to grow and doing everything they're doing on the digitization and the clean energy side, and as the U.S. continues to sort of try to be more self-sufficient on many of the different areas as well, different partners around the world are going to benefit from this new global supply chain that's going to happen, right?
That's a positive you see.
It is a positive because think about it. Mexico is going to benefit from the U.S. and in China, Southeast Asia, think Thailand, Vietnam, Malaysia, some of those countries are going to benefit from the difference in trading patterns as well as India. So, you know, you're going to see some shifts in the global supply chain, and I think that that's going to present some interesting investment opportunities as well.
I love that you went there because I feel like everybody's like, globalization, it's dead. It's going to be different.
No, it's going to be different. Globalization isn't dead. It's just going to look different.
So in terms of how investors play it, it's going to be different.
It is going to be different. I think it's really important for investors to consider having a very global portfolio because those that have been U.S. dollar-centric and U.S.-centric may not be able to achieve the same level of returns going forward the next 10 years if you don't have those global exposures that I mentioned.
When you, and I don't know how much you can drill down, but when you do look at Asia, because you mentioned, you know, some of the Southeast nations, so there's China, there's India, how are you guys thinking about that investors should play it?
Well, it's interesting because in China, when you think about it now, they just announced their first quarter GDP numbers, 4.5%, beating the analyst estimates of 4% and estimated to achieve almost a 6.5% GDP growth this year. So the momentum in the reopening has been extraordinarily strong, not to mention that travel within the region is already back to pre-COVID levels, that the consumption story looks very healthy with the middle class, which is several hundred million people, so that consumption story
So
is very
play
big.
Chinese names or play names that are going to benefit from that Chinese growth and momentum?
Both, and that's how we're doing it for our clients.
Where don't you want to be right now?
Are you? Where don't want to be? You know, it's interesting because we're fiduciaries for our clients, right? So at the end of the day, we're risk managers, right? We're trying to make sure that we construct really global, really diverse portfolios for clients. And, you know, right now our view is that clients should be 40-40-20. So 40% in equities and in high-quality dividend-paying stocks in specific industries that we like a lot.
I was just talking about that on TV. We were talking about strategies, and more and more investment managers are looking at what dividend-paying stocks. But
Dividend-paying stocks. Also looking at that fixed income component because the fixed income yields are still incredibly high and very attractive, particularly on the enhanced liquidity, municipal bonds, treasuries side. And then the last piece is really looking at opportunities in direct investing, private equity, hedge funds, which we think is an enormous opportunity in markets like this, right, where investors are willing to pay that illiquidity premium.
Ida, what do you make as someone who looks at so many different types of investments that are out there that increasingly every time I come to Milken, it's the private markets, private credit, private corporates. It just continues to grow, but useful for investors.
It is useful for investors, and we are also seeing that trend, particularly with our largest family office clients that behave like global institutions. They are very interested in looking at direct deals and direct investment opportunities as well as a complement to the overall portfolio, mainly because it's a different return profile, and the return profile can be very different from your typical equities and bonds exposure, and you have some interesting and compelling industry and geographic opportunities that could be very additive overall.
All right, so one thing I do want to ask you is the Fed policy and Fed meeting.
Yes.
What are you thinking around that? And what do you think what is the, because I feel like we go back and forth, and, you know, I keep saying to everybody, Fed's going to do what it's going to do when it meets, and they're going to look at what's in front of them. What's the constructive conversation around Fed policy, Fed decisions, and really Fed commentary?
Yeah. So the Fed last year increased rates at the highest velocity we've seen in a very long period of time. 7 rate hikes last year, 2 already this year, and another one we expect tomorrow at 25 basis points. But then we think that it's going to teeter off. So I think we're going to reach peak rates after this next hike.
So this next meeting tomorrow.
This next meeting. Yeah. And then we think it is going to stay relatively flattish and then eventually going to have to come down, right? As we see some of the unemployment numbers potentially going up with the layoffs that are hitting the system and the like.
Your research team, the strategy note I was looking at last night, it says what happens after the Fed reaches peak rates to play off of that. Not too soon to think about it?
No, it's not too soon.
In terms of strategy? And
no, it's not too soon at all. We've been making a lot of pivots in our clients' portfolios already. We anticipate a mild recession in the next quarter or two.
Okay.
And, we know that typically markets don't bottom until the midpoint of a recession. So we think there's going to be still some downward pressure on the equity side, some volatility in the near term. So we've been pivoting a lot of the portfolios, as I said, fixed income, looking at dividend-paying stocks in some unstoppable trend areas that we like, which include healthcare, clean energy, as well as digitization and deep tech, cyber.
Is that because of AI?
Of course, deep tech AI.
No, seriously,
it is because of AI, but it's also because of cyber. Because cyber is probably the number one thing on most CEOs' minds, and that spending is going to only continue there. And then you've also got to think about the implications of what fuels that industry, and those are semiconductors.
Really quickly, 20 seconds. Clean tech.
Yes.
That is another theme that I feel like keeps popping up. Is it because of some of the government money and the government programs, or what is it specifically?
It's a combination. It's a combination of this is where we're going to evolve in the future. It's the right thing to do for our world, for the environment.
Right.
It's going there. So we're going to move and transition from fossil fuels to clean energy and cleaner sources of energy. So we see a huge opportunity in solar, in nuclear.
More so than 12 months ago.
Not
or
necessarily
similar,
more
same?
so, but just this evolution is happening, and it's going to be an unstoppable trend in the next decade.
Ask the folks who live in California; they see it firsthand.
Oh,
right?
absolutely.
In terms of climate change.
Absolutely.
Thank you so much.
So lovely to be with you.
So great to see you guys. Really, and be with you.
Likewise.
Ida Liu, Global Head of Citi Private Bank, member of the Global Wealth Management Leadership Team over at the company. You are listening and watching Bloomberg Radio. I'm Carol Master, along with Jess Metton. It is time for a check on world and national news. Let's get over to Nancy Lyons. She's in our DC newsroom. Hey, Nance.
Thanks, Carol. President Biden is calling congressional leaders to the White House 1 week from today to discuss the debt ceiling. That's after the Treasury Department warned that a default could come as early as June 1st. Bloomberg's congressional reporter Eric Wasson says the White House is offering some concessions.
I think it's a significant movement that Biden has called this meeting. He's no longer demanding the GOP produce a full budget proposal, like they're going to basically take the House passed bill as the GOP starting point.
Again, Bloomberg's Eric Wasson. The Senate is planning to hold hearings this week on the potential impact of cuts that are called for in the House GOP bill. Expecting a surge of as many as 10,000 migrants a day when pandemic restrictions are lifted next week, the Biden administration plans to send 1,500 additional U.S. troops to the southern border. Pentagon spokesman Brigadier General Pat Ryder.
For 90 days, these 1,500 military personnel who will be sourced from the active duty component will fill critical capability gaps, such as ground-based detection and monitoring.
Ryder says the military members would also be taking on administrative jobs. Supreme Court ethics reform took center stage during a Senate hearing today, with Democratic Senator Richard Blumenthal condemning Justice Clarence Thomas for failing to disclose luxury vacations, and Republican Senator Lindsey Graham saying this is overreaching.
What Justice Thomas did in either misstating or avoiding disclosure is potentially criminal. That's a Department of Justice responsibility to investigate.
This is something the court should handle. I think there's a separation of powers issue. There's a orchestrated effort to come after the Roberts Court to delegitimize it.
Chief Justice Roberts was invited to testify but declined to participate. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story and a headline right off the Bloomberg Professional Service. Morgan Stanley in talks to resolve Department of Justice and SEC block trade probes. That headline breaking right now. The Dow, the S&P, NASDAQ all retreating today. Perhaps that's putting it mildly. A 1.1% drop in the Dow, down 367 points. We had the S&P down 1.2%, down 48. NASDAQ today down 132, a drop there of just about 1.1%. So a losing day for stocks only a day after Wall Street was breathing a sigh of relief for the rescue of First Republic Bank. A sell-off in regional lenders fueled renewed anxiety over financial stability. Case in point, shares of PacWest today down 27.8%. Also moving lower today, Western Alliance Bancorp down by 15.1%. Bloomberg Business Week caught up with Chris Ailman, Chief Investment Officer for CalSTRS, the California State Teachers Retirement System, at the Milken Conference, and he talked about those regional banks.
I'm concerned that the regional banks are getting hit one after the other. I mean, these two banks I've heard names of, but didn't even know where they were located. I'm surprised that we're having more contagion. We just had Citicorp's CEO here at Milken, and JP Morgan's representative say everything is fine. That was it. First Republic, and we should be done.
After the closing bell, lots of earnings. Among those reports, Advanced Micro Devices, second largest maker of computer processors, it delivered a lackluster forecast for the current period as it struggles to bounce back from a PC slowdown. And Starbucks posted sales that beat estimates as U.S. transactions increased. It is a positive sign for consumer spending, but performance in China also outpaced Wall Street expectations. 10-year yield, 3.43%. The 2-year, 3.99%. Gold up 1.7%, 2016 the ounce, and crude down 5.4%, 71.61 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I'm Carol Masser, along with Jess Metton. She's back, of course, in New York. I'm here at the Milken Institute Global Conference. As you know, we're on YouTube and also our Bloomberg Originals streaming service. The world's largest companies poised to face a 15% minimum tax under a 2021 deal to overhaul global tax rules as more countries begin to implement the measures. We're talking about more than or around 140 countries. So we wanted to get to some of the implications of it. And we're delighted to have with us Marna Ricker. She's Global Vice Chair of Tax at the consulting and advisory firm EY here at Milken. I do want to talk about that. First of all, welcome.
Yeah, thank you. Thanks for having me, Carol.
Great to have you here. But, you know, before we started getting going, we were talking a little bit about what's being talked about at Milken. You said there's been some really interesting panels. What's jumped out at you?
Yeah, I have to tell you, there's, you know, I sort of feel like at the end of the day, things are going to get greener. Right? We're looking for economic efficiency, not inefficiency, efficiency.
Right.
You know, I think that trade is going to be really interesting to see who emerges ultimately, what countries emerge, India, MENA, Africa, right?
It's moving around. Last conversation I just had was the same thing, that globalization isn't going away. No, it's going to be different.
That's exactly right. I really love that of, you know, China. You know, you were hearing people say decoupling from China. Now you're hearing them say de-risking, you know, or navigating with China. You know, you can't cut off trade with some of the largest economies in the world. And so I feel, I think I said to you, I feel a lot of optimism, frankly, more optimism maybe than I expected.
Did you go to any panels on real estate or on banking?
I went to banking. I stayed out of real estate. I won't predict there.
Well, talk to us about the implications, because another thing is, you know, I don't know that we talk tons about corporate tax structure and strategy, but it's a big deal.
It is.
So talk to us a little bit about this rule and the companies that have joined on, or the countries that have joined on, and the implications of it.
Yep, for sure. I love good tax policy, and so I do look at, it's called BEPS.
I love a person who loves good tax policy.
I do. I think it's a force for good, and I think it has the ability to drive, you know, behavioral change. And so what's interesting, I think, about
this is good leveling the playing field globally.
Yes, it is. That's exactly right. And so when you look at BEPS Pillar 2, that's what we're talking about here ultimately, starting in financial statements in 1/1/24. So for calendar year companies, they're going to get it under their rate. It It really literally is about what is the minimum tax around the world look like, and so what are those tax collections going to look like? And I also look at it with Pillar 1, which is much more about digital customer base, market rights to taxation. I look at that. This is all about modernizing the tax code.
Right.
We have a century-old tax code. It is a bricks and industrial type tax code, and we're in a really modern society that's extraordinarily digital.
When you say that, are you just talking about the corporate, or are you also talking about just overall?
Corporate. Really about corporate. Yeah.
As an individual, we got to do something.
Yeah, we got to do that too.
But we'll talk about that.
We're working on BEPS first.
So, what are the implications then for companies, for multinationals, right, who operate around the world, and they have, to be fair, have gone to countries that have had lower corporate tax rates to their benefit. So, as that changes, what's the impact on their balance sheet? What's the impact on the taxes they are paying out?
No, it's a great comment. The obviously taxes are a big line item ultimately on your P&L and your balance sheet, to your point, and deferreds. And so, I do look at this. When you look overall, what you hear from most companies, it's more of a shifting of where they're paying taxes.
Right.
But I would contrast that to what the OECD is saying. So their estimates on Pillar 2 roughly were $150 billion of new tax collection ultimately.
Okay.
That has been revised now up another $70 billion to $220 billion.
Okay.
So again, there's a little bit of, I think, reconciliation that's going to happen between the companies and obviously what the OECD is expected out.
So, Marna, net, companies, multinationals are going to be paying more.
That's
but where it's going, it's going to be different places.
Exactly. You've got it. And so I think that's what will be interesting to see shift. I think one of the big items, too, I want to make sure I'm flagging for companies and for our listeners ultimately is credits and incentives. So subsidies and credits and incentives that you were just talking about, whether those are green climate things that we're seeing.
Talk to me about that, because I was looking into a little bit of it, when it comes to sustainability goals, when it comes to your supply chains, like we know that is certainly coming in the United States. You want to build something great, but, you've got to make sure that the goods are here in the U.S. Alternative energy, green energy, that's not always so easy to do.
So that is an unanswered question. So that, I think that's probably the biggest issue on companies' minds, and I think the OECD is going to have to get that settled. So how you will treat credits and incentives and subsidies. Europe tends to use more subsidies.
Right.
I'd say the U.S. and more developed countries are using more credit-type systems, and so that's not reconciled yet on whether that's in the base for your calculation of this corporate alternative minimum.
Can I ask you, the higher taxes that essentially corporations will have to pay, and I would say that there are a fair amount of people out there saying, well, it's fine that the corporations should be doing it, but that's a whole different argument.
That is.
But what I do wonder, is it manageable in an environment where there's lots of questions about the outlook, about growth, about pressure on balance sheets?
I do think it's manageable. I think it's a journey worth taking. I do like good tax policy. I like consistency. Certainly, our clients and taxpayers are they're really looking for certainty.
Right.
How do they plan their operations?
What do I have to do?
These are huge capital investments companies are making, and they need to know that when they make those, they're going to have the outcome that they expected ultimately from a tax perspective.
What are you hearing from your clients, though? Then ultimately, will they be shifting around where they have operations because of this?
Yeah, so they'll always, not because of this, they will always, look, I've been in this business for 30 years, and companies, tax doesn't drive business. Business drives business, right? They're always going to make good business decisions. But again, they're going to want to be tax efficient about how they make those investments.
But that is so interesting, because there's often the argument of, no, people, tax policy does determine business decisions.
Yeah.
That's not necessarily.
I'd say it differently. I don't think you're ever going to make maybe just reframe it, right?
Yeah.
I don't think you're ever going to make a business decision solely on tax.
Right.
But there's no doubt, right, that if governments are trying to incent, onshoring or nearshoring right now, as an example, in sustainable, really self-sufficient, secure supply chains, they're going to encourage behavior around that, right? So we see that with the CHIPS Act on semiconductors, as an example, and obviously we're seeing it with IRA right now on climate.
One thing I wanted to ask you, just got about 30 seconds left here. AI, ChatGPT. For some reason, I've got to believe that that's going to simplify, to some extent, big extent, your world.
Absolutely. I'm so excited about it.
Are you?
Oh, we're doubling down on it. It's, when you think about it, we want to be data-enabled, tech-enabled, and we want to be playing to our highest level degrees and our highest level thinking. And so the ability of ChatGPT 4 in particular to come in a rules-based, data-based system and really push our thinking upwards and let us do judgment and, and the nuances around it, I think is extraordinary.
Ah, I love it. So
Super
you guys are
excited.
actively working on it.
We are on it.
Have you been on it before the Microsoft news?
We absolutely were.
So you're like, Microsoft, I got this.
Oh no, we're with them. I'm totally
You're
with them. Oh yeah.
This was really fun.
Me too. I enjoyed talking to you.
We did too. Safe travels home.
Thank you.
Lorna Ricker, she's Global Vice Chair of Tax at EY, of course, the global consulting and advisory firm here at Milken. You are listening and watching Bloomberg Business Week, and this is Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. We begin with a developing story. Morgan Stanley in talks with U.S. prosecutors and regulators to resolve a probe into its block trading practices. The firm has previously said inquiries focus on whether employees shared or used information regarding impending block transactions in violation of securities regulations. Down day on Wall Street, but the central focus today for investors, regional banks. Case in point, PacWest Bancorp. The stock plunged today by 27.8%. Also dropping today, Western Alliance Bancorp, down by 15.1%, certainly hurting sentiment today. Uber shares rallied 11.5% after the company reported earnings that beat analyst estimates, showing that consumers continue to spend more on rides and food takeout despite an uncertain economic outlook. Uber CEO Dara Khosrowshahi spoke with Bloomberg about the quarter. He was also asked about competition with Lyft.
And I think if you have Uber and Lyft competing not on who can have the lowest price, but who's got the best experience, who's got the best brand, who's got the better reliability or breadth of products out there, I think that, we can both do fine in this marketplace.
And again, today we did see Uber shares rally by 11.5%. Uber, of course, based in San Francisco. Its crosstown rival Lyft up by just about 0.5%. Advanced Micro Devices delivered a lackluster forecast for the current period as it struggles to bounce back from a PC slowdown. Those are our top company stories. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. Carol Massar live at the Milken Institute Global Conference. Right now, we do want to get an update on world and national news. Off to Nancy Lyons we go. She's in our 99.1 newsroom in Washington. Hey, Nance.
Thanks, Carol. Attorney General Merrick Garland says they've made 288 arrests and collected thousands of illegal weapons and hundreds of kilograms of fentanyl and opioids in what he calls the largest international drug bust against those using the dark web.
The drug traffickers are confident that by operating anonymously on the dark web, they can operate outside the bounds of the law. They are wrong.
Garland says Operation Spector spanned 8 countries on 3 continents. Senators are taking a look at creating legislation to impose a code of ethics on the U.S. Supreme Court. It follows revelations that Justice Clarence Thomas spent his vacations on the yacht of a rich friend. Bloomberg's Irv Chapman has more on today's joint hearing by 2 Senate committees.
Chairman Sheldon Whitehouse, who sponsored the bill, referred to the Thomas revelations.
Some of this personal hospitality involved people dedicated to turning the court into a tool for right-wing billionaires. The court has conclusively proven that it cannot police itself.
Ranking Republican John Kennedy said buckets of mud were being flung at Justice Thomas.
Some of my Democratic colleagues have been on a crusade to undermine the United States Supreme Court's legitimacy for years.
Chief Justice John Roberts was invited to testify. He declined, and the committee heard instead from law professors and retired judges. In Washington, Irv Chapman, Bloomberg Radio.
States are bracing for the economic impact caused by the Hollywood writers' strike. The union and studios failed to agree on a new 3-year contract, and the Writers Guild of America announced the strike beginning today, effectively halting most productions. Aside from the obvious impact felt at Los Angeles and New York, states including New Mexico and Georgia that have seen a production boom will also feel the effects in lost revenues. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carol and Jess.
All right, Nance, thank you so much. Carol Massar live at the Milken Institute Global Conference in Beverly Hills. We are on YouTube on Bloomberg Originals. And, of course, back in our Bloomberg Interactive Broker studio in New York City is our own Jess Metton. And, Jess, no surprise on a day where we saw those regionals once again under pressure, some volume behind it, a few names in particular, but the whole regional banking sector just seeing a bunch of selling. That if you take a look at the most read stories on the Bloomberg in the past 60 minutes, you've got a bunch of stories up top that are dealing with this. Short sellers tightening the grip on the regional banks in the run-up to the rout. And then I thought this was interesting. The most read story on the Bloomberg in the past hour, Stanley Druckenmiller, well-known hedge fund investor, longtime deficit hawk, saying the current impasse over the debt ceiling is dwarfed by the dangers of unchecked future government spending. And that is something. All right, so we're worried about the banks, but I am finding increasingly with the Milken conversations here that people are saying, yeah, we're worried about the debt ceiling. What we're really worried about is the debt accumulation on the U.S. government balance sheet.
Exactly, Carol. And whenever you were talking with Purnima Puri over at HPS, she actually had pointed that out. Obviously, people talking about the Fed, but when it came to the impact of QT as well as the debt ceiling, but not just the debt ceiling, as far as the amount of servicing U.S. debt, how much that was still a concern for her. And so to your point, more people talking about that, even just beyond the Federal Reserve as we get closer toward the summer in that potential X date that everyone is talking about as far as what a potential debt